My name is Elizabeth Warren, and I'm the chair of the Congressional Oversight Panel. I'm here to introduce our third monthly oversight report, which has the snappy title, Valuing Treasury's Acquisitions. In our first oversight report, released 2 months ago, we asked Treasury a lot of questions. One was whether the public was getting a fair deal when it put taxpayer money into financial institutions and got shares of the business back out. Secretary Paulson said yes, the transactions are at or near par, which just means that when the taxpayers put in $100, the value of the shares they got back was also $100. That sounds fair. We could have stopped there, but we decided that we should check this out for ourselves. So we got together some big-time finance experts, and we commissioned our own very technical and very sophisticated review of the 10 largest purchases made by Treasury with TARP funds. There's a 700-page analysis and a supplemental legal analysis of the deals on our website, but here are the highlights. First, we learned that on the next day after the deals were announced, after everyone knew that the banks were going to get billions of dollars, the value of the stock and warrants that Treasury received was far less than Treasury paid. Second, we found that the difference between the price paid and value received was greatest for those institutions that were in the most trouble. And third, we learned that the deal Treasury received was not nearly as good as private deals that were not completely comparable, but that were made at about the same time. Now, Treasury may have good reasons for this price difference. We want to hear more, but we're not yet ready to wrestle with the question of whether these kinds of subsidies are a good idea. Not yet. Instead, we want to start with one really important point. We think that Treasury should have leveled with the American people about the purpose of the program. If we are going to subsidize the banks, and subsidize some of them a lot more than others, then let's not dance around about it. Explain what's happened, and let's have a good old-fashioned debate about whether this is the smartest way to spend our money. We think the hard numbers are important right now before we spend any more money. So here's how it works out. In the 10 largest transactions made with TARP funds, every time Treasury spent $100, it took back assets that were worth, on average, $66. Do that enough times, and it adds up to a $78 billion shortfall on the first $254 billion in deals. The numbers get even more interesting when you break them down by program. In the 8 deals made under the Capital Purchase Program, this is the program designed for so-called healthy banks, we found that Treasury received $78 for every $100 spent. In the 2 deals made under the programs designed to provide aid for financial institutions that pose a higher risk of failure, Treasury spent $100 to get back assets worth only $44. So that tells us about the market value of what we got. But some people think the markets are a little crazy right now. Okay, so we have another comparison. We lined up Treasury's investments against 3 large transactions made by private investors during the same time period for an idea of what a determined investor could get in the market at that time. These deals aren't directly comparable because the terms are different, but they tell us something about what a big purchaser of assets might ask for and get. The 3 deals we used as a comparison were the same ones we mentioned in our first report. Using the same very technical methods we used to analyze the Treasury deals, we found that the private investors bought assets worth at least what they paid for them. Here are the numbers. For each $100 Mitsubishi invested in Morgan Stanley last September, it got securities with a fair market value of $102. For each $100 Berkshire Hathaway invested in Goldman Sachs last September, Warren Buffett got securities worth a fair market value of $110. And for each $100 Abu Dhabi and Qatar invested in Barclays in October, they received securities with a fair market value of $123. I'll say it again, these numbers are not directly comparable, but it gives us an idea of the ability of a big investor to extract bigger price concessions. There's one more important point. The company-by-company numbers are along a range. While Treasury got $93 for every $100 it paid buying equity in Wells Fargo, it got only $50 for every $100 it invested in Citibank. The gap between value and investment in Treasury's deals suggests that these things that Secretary Paulson called investments were actually subsidies for struggling banks. With a new administration in place, Treasury may have some time to rebuild TARP's credibility with the public. Either way, our panel's job stays the same. We keep pushing for answers and more transparency from Treasury, and we keep coming back to you with what we find. You can read our latest report and follow our work at cop.senate.gov. That's cop.senate.gov. We're talking about a lot of money here, and since it's your money, we think you have the right to know how it's being spent.